Hey, you want to control your money? Great. You're going to change one thing. That's where your money goes first. You're going to add one step. That's called the infinite banking concepts, which will put you back in control of your money, but also allow you to take back the banking functions in your life. In today's video, I'm going to show you one of my policies I designed when I was 44. I'm going to show you how we design these policies to benefit you from a high cash value standpoint. But then I'm going to show you how it really works, and I'm going to show you how to build wealth through your own debts and expenses. Yes, your debts and expenses can help you build wealth. So that's what we're going to go into. Let's dive in because it's freaking cold out. You know, when you talk about the infinite banking concept, we're really talking about a process that somebody has to learn, but that process, once learned and applied in their life, will allow them to take back all of the banking functions in their family's lives. In other words, they will no longer need to rely on banks. And banks are not our friends. Banks are not there to help benefit us. Banks are there to benefit their shareholders and the bank itself. And that's really where the shift comes. The infinite banking concept is just that, the process that puts you back in control of your money and puts you back in the driver's seat of the banking functions that we have all but given away in our lives. And it really, I'm just going to do this quite simply with one of my policies. Now, this is just one of the many policies that I have. I started this one almost 5 years ago, but we'll say at the age of 44. I'm 48 now. And this policy, and don't get hung up on the numbers, folks. This policy, when I set it up for $30,000 a year in premium deposits. Now that number can change. I've done many videos with Christy where I've shown policies for under $400 a month in savings. Okay, so it doesn't matter what your savings level is. I'm just using this because I had my own numbers from one of my policies, and I thought it was a good exercise because one of the things a lot of people don't really they just get hung up on. And we were talking about our family members and how we're always trying to help our family because inherently we want to help our family, right? We want our brothers, our sisters, our parents to live a better life financially. And because we've learned this, because it has changed our life, we want to pass it on. But unfortunately, a lot of times our parents, our family members, and our closest friends, even though they ask us for help, the second we try to help them, they think we're like insulting them. They think that we're like trying to say something to them that puts them down, when we're really just trying to show them, here's how I solved the problem, and here's how you can do the same thing. But, you know, I think sometimes that's the most difficult thing. So I'm really happy that I get to talk to your entire audience because I'm not talking to my family and trying to teach them something that they just, you know, they say they want to learn, but they don't. So with this, the big hang up people have with the infinite banking concept, and a lot of the people that we work with, is the vehicle, the machine we use to move money through. And the machine is not something new. It's not something that, you know, it's just come out. It's been around for hundreds of years. And that machine is especially designed and engineered whole life insurance policy. So a lot of people would ask, why would you use a whole life policy? And they go online and they look it up and they hear the guru say, oh, that's the worst place you can put your money. But is it really? And let me demonstrate that. This is numbers right off of one of my illustrations. And I would be happy to show the illustration, but I summarized it. So in the first year, when I was 44, I put $30,000 into this policy, okay? And I had access to $27,534 of that $30,000 in the first year. Now, some of the people that are watching are like, well, it's not 100% of the money you put in. You're right, because I got a death benefit for my family for $765,367. That's how much my death benefit was on this policy. Now, remember earlier I said this isn't a normal whole life. I said it's a specially designed and engineered whole life, which is what I want to show you. And I want to show you what we have to give up so that you and me, I guess you could say, benefit for the high early cash value. But let me just go 5-year increments. At 44, I started this policy putting $30,000 in. Now, I'm going to be 49 in July. So when this policy turns, well, when I turn 49, here's where we'll be. I'll put $29,900 into this policy. I will have a cash value of $184,651. Now, that's not a small chunk of change. And I'm going to just grab a calculator here real quick because I want to show you this. Now, I'm going to round up, which is actually going to kind of make this look worse for me because remember, I'm putting $100 less. But I just want to show this to you. So I put $30,000 in, and let's just say I did that for 5 years. I will have put $150,000 into the policy. So now let's just do the math. I started at 44. When I'm 49 years old, which will be this July 28th, I will turn 49 years old. Okay. I will have put roughly a little less than $150,000 into this policy over those 5 years. But I have $184,000 that I could use. So, I mean, you don't need to be good at math, but I made $34,651. Now, I know some of you are thinking, oh, that's a terrible return, because you're going to do the math in your head and be like, I'd make more putting it in the S&P 500. I'd make it more putting it in something else. But here's what you don't understand. You don't understand how the infinite banking concept works. So let me just go back and explain something. Then I want to show you how the design is engineered so that it benefits you. But let's just say somebody said, oh, that's not a good return, 34,651 over 5 years. And I don't know whether it is or isn't. I'm not doing the math. But let me just pose this. If you were making that comparison, you'd have to make that comparison to somewhere else you could put that 150,000 over 5 years where it would have earned a higher return. And you could be the judge of that. But here's where I'm going to call your bluff. You see, I could make the return I just showed you plus the return you're going to tell me you would make. Pick any asset class. I don't care, whatever you know, like, and understand. Some of you are like, oh, I would have made more in Bitcoin. Some of you are like, I would have made more putting it in the S&P 500. Some of you are going to say, I would have made more in real estate. Great. But I'm going to tell you you're wrong, because I would have made the same amount you would have made plus the return here. Now, what do I mean by that? Well, let's go to year one. I put 30,000 into this policy. And just so you all know, just for full transparency, this was with a company called Mass Mutual, and this was a product called the HEC V. Okay, it was a very unique product that reduces the commissions to the agent when they sell this, but gives you high early cash value. Every policy we design is a high early cash value policy. I'm just picking on this one, which is one of mine. I could take this 27,534 out in the first year anytime, and I could take it out as a loan. The insurance company would allow me to use their money from their general account, and I could use that money for anything I want. So what is the asset that you would invest in that you said would have made a better return than this whole life policy? Great. Let's take 27,534 and let's put it into that asset. You see, I'm making money twice. You're only making money once, because chances are when you invest your money has to come from a bank account. You're taking your money from your bank or your checking account and you're investing it in whatever that is, real estate, Bitcoin, some crypto, or the S&P 500, whatever you want, okay? You did that. But when you took the money from your bank account and you put it into your investment, that money that was in your bank account no longer earns anything for you. But it earns in whatever the investment is you invested in, right? I'm just trying to paint this picture. You see, when I do this, I take a loan from the insurance company's general account, which they don't ask really any questions. 4 questions. What bank account you want? Is it part of a divorce decree? A couple other simple ones. And then that money goes right into my bank account, which then I invest in the same asset as you, except for the insurance company continues to pay me guaranteed interest and dividends every year. Like the money never left my account, because the money in my policy's cash value, this 27,000 that I'm saying would have been taken out as a loan and invested in whatever this asset is, that money never left my account. It's still in there earning. I didn't use my money. I used the insurance company's money, and they charged me interest on that money, which we'll get to, a simple interest rate. So back in, when I was 44, if I'm not mistaken, the interest rate was 4%. Today, it's like 5.35%. Okay, so it does fluctuate a little. So I got to pay interest on that money. But you know what? How much am I earning? Well, today, as of right now, 2026, Mass Mutual's dividend crediting rate is 6.6%. You can look it up. Google Mass Mutual dividend crediting rate. It's going to say 6.6%. So Mass Mutual is paying me a gross dividend crediting rate on all of my money at a rate of 6.6% by today's numbers. And when I was 44, took this out, it would have been a little bit less because dividends have gone up. But you see what I'm trying to say? I get to make money twice. My money didn't lose any opportunity to earn while I took it out and used it. I just had to factor in what was that cost for the capital, that interest rate the insurance company charges me. But no matter what, no matter how we play this out, I'm going to beat your returns, because our returns are going to be the same. Whatever you made in that Bitcoin, that real estate, that market-based investment, I'm making the same return, but I'm still making the return here, which, remember, I said over 5 years, I made, what was that number, 34,000 and change? There's the math. But you see, every single year that goes by, I make more because my money's compounding on an uninterrupted basis. Just look at this. 5 years after that, I'm 54 years old. I put 12,000 in. My total cash value is 353,181. Now, again, I'm not breaking all this down because just like the disclaimer says, your values may differ or will differ than mine. So we don't need to get into semantics, but let me show you how this works. Because I guarantee you, if any of you go out there and you talk to your agent, okay, your life insurance agent, or you talk to your financial advisor, they're not going to know how to design a policy like this, or they're not going to want to. So let me unpack that real quick. How we design these policies is kind of like how a spaceship gets into orbit. Now, I'll show you the diagram of that. But there's two basic components, okay? There's the base policy, which is the normal whole life insurance policy. This is what your advisor or your agent would typically sell you if you bought a whole life policy. They would sell you 100% of the premium going to the base. But we don't do it that way. So when we design these, we use a special rider the insurance company gives us the option to use called a paid up additions rider. And that allows us to take our money or a percentage of our premium deposits and put it into the general account of the insurance company. And then the return is we get that money earning that dividend crediting rate. So here's how it breaks down on my policy. The base is 40%. So if I put 30,000 in the first year, 40% of that 30,000 goes to base. And again, right now you don't know what that means. So I'm talking over your head, but we're going to bring it full circle. Where 60% of that $30,000 goes to paid up additions. So right now you don't know whether that's good, bad, or indifferent. But let me explain this. For me, as the agent or the advisor selling the policy, that's really bad because I get paid on the base. I get paid roughly in New York, 55% of whatever premium goes into the base. So if the base was 100% and I made 55%, well, on every 10 grand, I'd make 5,500 bucks. That's not bad, right? But in this, with the way we design, only 40% went to the base. So now out of every $10,000, only 4,000 is going to the base, to which I'm making 55%. The other 60% is going to a paid up additions rider. The paid up additions rider, which is getting 60% of that, only pays me roughly about 2%. So how many of you, if you were selling a product, would want to make 2%? Or how many of you would want to make 55? I think all of you would want to make 55%. But see, it even gets better. This product, which was a Mass Mutual product that still exists today, they don't pay 55%. Nope. They pay 11%. So now, instead of making 55% on that 40% going into the base, I make 11%. So to sum all this up, in order to design and engineer a policy this way would require the agent or the financial advisor to reduce their commission in this product by 88%. That's the math, 88 to 90%. Every policy we design, we have to reduce our commission by 60 to 90% so that you have 60 to 90% more cash value to use immediately. And I mean immediately when I say this, I mean immediately in the first 30 days from the day you make the deposit into the policy. But what did I get for that? Because some of you are still hung up saying, well, Chris, if I put $30,000 into my bank, I have $30,000 to use the next day. And Chris, you only had $27,534. So what did I get for that? Because that is a cost, right? That definitely is, meaning I had to pay the insurance company some money. Well, number one, I had a commission. Remember that 11%? I got a commission on this. But what else did I have to do? Well, I had to have a death benefit on this policy. So that death benefit protects my family. So if something happens, I got a little 5-year-old. Her name's Vivi. If I died today on the drive home, God forbid that ever happen, I would want to make sure my family's left in a better place. And just this one policy would leave my family $765,000 better. They could do a lot of things. They could pay off the mortgage. They could pay off, whatever they wanted. But that's the case. Okay. Now, in the design of this, that death benefit, you notice how it's a weird number. That's because we don't maximize the death benefit in these policies. We put the lowest death benefit on the policy possible under IRS guidelines, because that's something else I forgot to tell you. Whatever those returns were, I showed you that $34,000 I made in that first 5 years. Did you realize that because this policy is designed properly, that's tax-free. So did I really make that return? Yeah, I did. And I got to keep it all. I didn't have to give any of it back to the government in the form of taxes, where you would have to. If you made a return on your bank account, okay, at the end of the year, you get a 1099 INT. But let me go one step further because I want to show you something that I think will make this super easy. When we talk about the design, right, we always have a destination where we're going, right? We'll just call that Earth. So if you were building a rocket ship, you would have to build, and I know you've all seen rocket ships take off down there in NASA, and what do they call that place in Florida? Port Canaveral, I believe it is, where they launch all the rockets. Yeah.
Right.
So down there, when you see the rocket ships lining up, okay, or sitting on that thing, they have these ginormous booster rockets, okay? And you've all seen those booster rockets. You've seen them take off. The rocket can't get off the ground without these giant booster rockets, okay? That's what all the thrust comes from, and it just blasts off, and this thing gets up into space. But once it gets out in orbit, what happens to the booster rockets? You see, they become inefficient. They were only designed to get that rocket from 0 miles an hour sitting on the ground, that giant heavy rocket. It boosted up into the sky, into space, and it does it in a very quick period of time. But once that rocket gets into space, what does it do? I mean, listen, Elon Musk has literally perfected this, and he lands these booster rockets, which we're going to call these the paid up additions, okay? These paid up addition booster rockets, they fall off. We no longer need them after the 10th year. So you didn't see that when I was showing it a second ago on the one. We're only going to keep the paid up addition riders on the policy for the first anywhere between 8 to 10 years, because after that, they're just not as efficient. So they come off of the base, and now that 40%, because remember, 40% of your premium deposit was to the base, 60% was to the paid up additions. The 40% base is the most efficient part in the later years. And I kind of showed that, but let's go back. See how here, when I'm 54 years old, which is roughly 10 years from when I started this, see how it drops from 29,900 to 12,000? Do you know what that is? That's us dropping those paid up addition riders. And when we do that, this policy becomes even more efficient. If we started adding up all the numbers, you would see what the returns are. They're phenomenal. But that's because we had to design the policy to get off to a quick start so that we had immediate access to our cash value. And then once we got into it and the policy became more efficient like the rocket, we dropped those paid up addition riders. And now our rocket ship is efficient as it can be from a return standpoint. Now, whether or not that made sense to any of you, I apologize if it didn't, but that's just a really good way to look at it. But now let's get to what matters. And this is what I told Christy we were going to talk about. Let's talk about the infinite banking concepts. And what I did here is I did something that we show a lot of people to do, and that is we're going to pay off some debt. Now, most people, when they work with Christy and they learn about the velocity banking and they learn about how to pay off debt, it's incredibly, incredibly efficient. Okay. But there are some people that just don't have that HELOC. There's some people that don't have that line of credit. This provides another alternative. But here's the best part. This that I'm going to show you works incredibly well with velocity banking. Matter of fact, we can pair the two together. We call it the Debt Blaster trifecta. And we've created software called the Vault software. You can get that by going to BYOBvault.com. And that's it's like an operating system. I like to call it a GPS for your infinite banking concept. So what I'm going to teach you now. But some of you are going to watch this and you're going to be like, that's too much work. Great. The Vault, that's what it's for. It's so that you don't have to do the work. The software does it all. But again, let's get into this. Remember I said all we're doing is we're changing one thing, and that is where your current savings goes first. Remember in my policy, I showed you where I moved $30,000 of savings into that specially designed whole life. So in this scenario, I'm going to do a different one. I'm going to assume someone, okay, that has $15,000 sitting in a bank account. They were saving that money to pay off debt. They were saving that money for a rainy day. They were saving that money for an emergency fund, whatever you want to call it. They had 15 grand sitting in a bank, and their bank was paying them less than 1%. Does that sound like any of your bank accounts? Less than 1%? me and Christy talk about bank accounts all the time. I know we've been in this interesting period of time with high interest rates where, you can find high yield savings accounts that pay you what, 2 to maybe 3, maybe even 4% now. But once the Fed drops interest rates, those high yield savings, they lose interest, don't they? The interest rate goes down. You're not in control of that interest rate. So here inside the policy, we are, because the policy is going to pay you a guaranteed interest rate in your contract. And most of the policies we deal with are anywhere between 3 and the highest is 3.75% guarantee. Plus you get the dividends. And if you remember, I said the dividends on my policy were 6.6, but depending on what company we use, they're usually 5.9 to 6.6, and they call that a dividend crediting rate. You can look it up for any of the companies we deal with. All right. So somebody's got $15,000 and they hear that they can make, six, we'll just call it 6% dividend crediting rate. Even if it was only the 3% guarantee, that's still better than you're getting your bank account. Oh, and that's tax free. Oh, and it's protected against judgments and liens inside the policy. And you get the death benefit to protect your family. You see how the benefits stack up? So now all of a sudden, when you're comparing your bank or your safe place you keep your money to this guaranteed whole life insurance policy, you start weighing them out and the whole life wins 100% of the time. I mean, people are just like, why would I keep money in the bank when I get all this over here with this? Exactly. Okay. The only reason people don't do that is because some guru tells them, oh, whole life is the worst place you can put your money. I just showed you one of my policies. You should see the rest of them. Like that person that's telling you that, they simply don't know what they don't know. But coming over here, $15,000 is going to shift into the policy. Now, this is a one-time dumping. I want you to think about it this way, okay? And for those of you watching this, I'm just going to grab some money here. Imagine this money is the money that's sitting in my right pocket, which is my bank account. I hear about one of these specially designed whole life policies that pays me more, tax-free, protected, and it gives me a death benefit. So I take that money out of the bank and I shift it over here and I put it into this pocket. One time, that's all I did. That would be the equivalent of this $15,000 dumping. But then every single month, I want to still continue to save. Now, let's just pretend, and I'm just making this up, that I was saving $300 a month. Yours may be more, yours might be less. It doesn't matter. We can design these policies to be anything you want. I'm just giving you an example. So let's just assume someone dumps in 15 grand one time, and they're then going to save $300 a month. So what are we going to do? We're going to put the money in this whole life policy, but the money is not going to stay there because we're going to see how to build wealth through our own debts and expenses. Now, let's go over here to what I call the opportunity. And the opportunity is to pay off your debt. Yes, that is a huge opportunity. But let me prove it to you. Let's just, and I'm making this up. Let's just pick on 3 credit cards: Visa, Discover, and Amex. Let's use a case study where an individual would have all 3 of these credit cards and they have balances on them all. $5,000 is owed to Visa, and Visa is charging them 29% per year, and they're making monthly payments of $500 a month to try to pay this thing off, okay? And Christy, this is very common. You see this every day. They also have a Discover card that has a $2,000 balance, and they're paying $300 a month, and the Discover card's charging them 15% interest. And then they have an Amex that they did for their Delta reward points or whatever you want to get from the Amex rewards. They got a $3,000 balance there. They're paying $400 a month, and that's 20%. So I summarized all this because I wanted to make it simple. This person is $10,000 in credit card debt. This is not uncommon. This is actually probably low when we look at the averages. If we take that monthly payments that they're making on these 3 credit cards, trying to pay them off, because they're making more than the minimum trying to get these things paid off. They're paying $1,200 a month. Think of that. That's $1,200 every month leaving this individual's family. That's $1,200 less to pay for groceries. That's $1,200 less for entertainment, to go out and do things with the family. That's $1,200 that family will never, ever get back because it's a monthly payment that they're making, okay? The interest rate, if I take all 3 of those, the 29, the 15, the 20, and I divide it by 3, that averages out to be 21.33% average interest rate. Now, that's quite a bit, right? Let's spin that and let's put that into perspective. Let's just say you found an investment that was guaranteed to pay you 21.33% on your money. Would you move your money into that? Would you take as much of your savings as you could find and put it into that 21.33% guaranteed return on your money? You would. Every one of you would. You would. I don't even know what you'd do. You'd probably go borrow money and put it into there to earn 21.33% because it's guaranteed. But you see, here's what a lot of people fail to realize. This exists for most people because they're paying debts. That 21.33%, that's money you're giving away every single year to your debtors. So just imagine if you didn't have to pay Visa, Discover, and Amex here, and you could just save that money yourself. What would be the return if you didn't have to give it away to them? It would be the same return as you're giving up to them. It would be 21.33%. So let's start there. That's a pretty good return. Now, I already framed this up, so this should be easy. We put 15 grand into the specially designed whole life. We put it in all up front. So you have access to your money immediately in the first 30 days. But all we need is 10,000, okay? So we're going to take a loan from the insurance company for $10,000. And the insurance company is going to charge us 5.5% interest, simple interest on that 10 grand. So the $10,000 hits our bank account, which we would always tell our clients to set up a segregated bank account for their private banking. So for your infinite banking concepts, which is the same as privatized banking, we want to keep track of everything. We want books and records. So before you ever do this, when we set up your policy for you, which we'll give you a link to do that. Christy's got a link up in the description, okay, to book a call. So we set your policy up. We're also going to have you go down to your favorite bank that you have all your other accounts at, and you're going to open up a new checking account. And we're going to just call that your segregated checking account. And when we take a loan from the policy, 10 grand is going to hit that bank account. We have record of the first loan. Then that 10 grand is going to come over here to the opportunity zone, which in this case, your biggest opportunity is your debts. Remember, we want to build wealth through your debts and expenses. But I already showed you how much money's leaving. Now let's just flip that and have that money help you build wealth. It's easy. 10 grand comes over, we pay off Visa, we pay off Discover, we pay off Amex. We take the exact same amount we were paying to Visa, Discover, and Amex, $500, $300, $400. That's $1,200 a month. So we take $1,200 a month, and we no longer have to give it to those companies, those credit card companies. So now every single month, $1,200 a month is going to flow back into your segregated bank account. Now you can set this up with a bill pay. You can set this up a lot of different ways, but just know you no longer need to give $1,200 away to the credit cards. So therefore you keep $1,200 a month. But you see, the game isn't over. We're not going to stop there because this is where math is a really awesome thing. But before I go to the next step, Christy, I want to explain one more thing. We started with 15 grand and then we're saving $300 a month, but let's just focus on the 15. We took $10,000 of the $15,000 out to pay off these debts. Now, people could do this from a bank account. They could do this from anywhere, but let's just think about the math. And I want to make sure your audience is understanding what I'm trying to explain. We started with 15 grand. We took 10 grand to pay off your debts. How much money is left in that whole life insurance policy earning a dividend crediting rate?
15,000.
15 grand. Not 5 grand like some people, because some are like, well, you took 10 grand out. But if you were listening earlier, we didn't take our money. We took 10,000 from the insurance company. Matter of fact, the insurance company went into that death benefit and they subtracted, sorry, not 10%. They subtracted the $10,000 from our death benefit. So if your death benefit started like mine at $760,000 and you took a $10,000 loan from your life insurance policy, they subtract the $10,000 from that $760,000, so you would have $750,000 of death benefit left. That's just an example, but I'm just trying to help you understand what's going on. Then the insurance company collateralizes the loan they gave you from the death benefit with your money. But that means all of your money stays in your cash value, continuing to earn guaranteed interest plus dividend while you got to use it to pay off the debts. Everybody understands that? So now we're going to fix the game one more time. We're going to take that $1,200 a month that we're no longer giving away, which, just so you all know, is the same thing as earning 21.33%. Hopefully everybody understands that. Every once in a while people don't. But if you were giving away interest every single month and every single year to the credit cards, and you pay the credit cards off and you take the same amount you were giving the credit cards and you put it into your bank, how much money or how much return did you just recapture? The same amount you were giving away, which was 21.33%. So in effect, you are recycling and recapturing a 21.33% return on your money, guaranteed, because there's no risk here. You're in full control of this. So now what we're going to do is we're going to take that $1,200 every single month and we're going to add one step. We're going to add that step to take $1,200 from the bank, because we don't want the bank hanging on to our money. We know they're not our friend. We're going to take that $1,200 every month and we're going to shift it back to the whole life policy. So remember, we took $10,000 from the insurance company and they charged us 5.5%. But now every single month, we're going to apply $1,200 against that 10,000. So in the first month, now you've got, do this right, 1,200, whoops, that would be $8,800 that is left, okay? 1 month has gone by. You took the $1,200 you used to give the Visa, Discover, Amex that you lost, it never came back to your family, and you shifted it over to the policy with a loan repayment form. We call that a recapture. Now that $1,200 is immediately available to you the very next day when your check clears. So you lost no liquidity of that money. When you paid it to Visa, Discover, Amex, you lost liquidity of at least the interest portion of it. But when you put it back into your policy, you have exactly the same amount of money. So it wouldn't matter whether you keep the money in the bank or put it into the policy if you had full liquidity, right? But it would matter because now, like I said, you just applied that against the balance that you took from the insurance company as a loan. So now the insurance company is charging you 5.5% simple interest, but they're not charging you 5.5 on 10,000. After the first month, they're charging you 5.5 on 8,800. So do you think that 5.5% interest on 8,800 is less than 5.5% on 10,000? Exactly. Now do that every single month, because why wouldn't you? Because you're not losing liquidity. Every month you subtract the $1,200. It just happens automatically. So after 1 year, are you paying 5.5% APR? No, you're paying a lot less. I want to show you something here because I ran this. And this is not a great example. The Vault software would do a way better job, but I just want to show you something. I just went here to Experian. I just did a Google search, and I did a Google search on a credit card payoff calculator because I wanted to show this. Here is the exact same scenario, $10,000, 21.33%. Now forget about the monthly payment because remember we were paying $1,200 to it, but let's just run the math here and calculate this. Remember, the interest we were paying to the insurance company was 21.33, but over here, I want you to look at the interest paid, okay? So this would show that it would take you 10 payments to pay off your total debt, okay? You would pay $10,920. You lost $920 in this scenario if you paid your debt off this way, but you didn't pay 21.33% interest. You only paid 8.42 because that's the APR. The only reason I wanted to show you this example is because this is how a lot of people would figure it out. But it's the same exact thing when you're looking at the insurance company. The same thing. Because the insurance company is calculating the interest on the remaining balance, but we're repaying the remaining balance. So let's just count how many times you made money here. Number one, we took our money from the bank account, we put it into this whole life. How much was that whole life policy paying us? Well, I had said, and you know, the guaranteed interest rate is 3% in the contract, but the dividend crediting rate could be anywhere between 5.9 and 6.6%. So you're making that, okay? But you're also making money on a spread because if the insurance company is paying you or charging you 5.5, but you were paying 21.33, well, take the 21 minus the 5.5. Are you not making a spread just like a bank would make? You are. So now you're making money once on the compounding interest, twice on the spread, but now we could add one more way. You're increasing that spread every month because you're paying down the balance. So your APR is going down. So every single month, this 5.5 spread changes. And after a point of a year, I bet you any money, it'd be like 4.6% that you paid. So now your spread just got bigger and it gets bigger every month. Isn't that the way you want your money working for you? I certainly do, because that policy that you showed, or I showed when I took at 44 years old, that policy was used the same way. I paid off all my debt with my policies. I paid off all my car loans with my policies. I lend money from my policies. I buy real estate from my policies. I loan money to my company for marketing from my policies. Anyway, on and on and on. It's endless. That's why it's called the infinite banking concepts. But I just wanted to walk you through the policy machine, okay? The place where we put our money and why we do it, which I showed you. Then I wanted to show you how we do that and how it requires us to reduce our commissions in design, because the majority goes into the paid up additions, the minority of the premium goes into the base, but in the later years, the base is the most efficient. And then I just showed you application of this whole thing in a simple circle, because your money is starting here in the policy, and then we are moving our money around to the opportunity zone and then back from the opportunity zone into your private banking system, meaning you never ever gave up control of your money and you took back all the money you were giving away. So I know that was a lot. There's a lot to unpack, but at least it shows you how you can make more doing exactly what you're doing today. And that's the only thing you have to do is change one thing, and that's where your money goes first, and then add one step, and that is this process. And if this is too much for you, use the Vault software, and all you do is you just follow instructions just like you do every day you get in your car to drive somewhere you don't know how to get to. You put the address in your GPS, and then you just turn right, turn left, go straight, get off at this exit, and eventually, boom, you're at your destination.
Okay, so I'm going to ask a question that I know people are screaming out there. If it's this easy, why have we never heard about this?
Same reason why our family members, which we talked offline, aren't using this. I mean, think about it. Like I've got cousins, I've got a sister, I've got a stepmom. None of those use this. Why? Well, I always revert back to the Will Rogers statement. He said the biggest problem in America is not what people don't know. He said the biggest problem in America is what people think they know that just ain't so. I can't explain to you why everybody isn't using this, because it always mathematically makes sense. But yet my own family members, they're not jumping up and down using this. They're not out there telling all their friends how to do this. They haven't even started this. Yet I'm their son, I'm their cousin, I'm their brother. And they ask me all the time, hey, can you help me with my money? And I say, yeah, watch this 90-minute video and it will show you exactly how to do it. And then I'll help you after you watch the video. None of them to date have watched that video. So when you ask how come everybody isn't doing this, because it's so simple, I don't know. Probably the same reason my sister and my cousins aren't doing it. That's the only answer I have for you.
I agree. It's the same thing with velocity banking. It's like the mindset is there, and well, this is the way we know how to do it, and we're going to keep doing it that way. And I think that that's the probably saddest statement that I get, and it is from family, usually friends. It's just like, well, I'll just stay with this. Hey, I'm doing it my way. They actually get mad at you when you bring it up, because you're like, oh, are you shaming me for my debt? I mean, I've literally heard that from family members. So the idea for me is I want to get everybody out of bondage. And now you are coming in to the channel with a way that not only can they get out of bondage, but they can build wealth at the exact same time. And I'm so thankful, so grateful that I learned about both concepts, because it has completely changed my life. And when I went out the first time to get these infinite banking concept policies, an agent in my area, I had just been working with him, and I just assumed, oh, well, I'll tell him what it is and he'll set it up. It took him about 2 weeks, and he came back and he said, okay, so I found somebody that knows exactly what you're doing, so we're going to set up your policies. And when I get them, I'm like, okay, sounds like a good deal. And then I start really studying the infinite banking concept and realize you shouldn't even use IULs. And that's what all 4 of mine were set up as an IUL.
All right, you got it. Thanks so much.
All right, bye-bye. Thank
Bye-bye.
you.